Yes, people, welcome back to the channel. Hope you're well and in good health. Okay, so right now we're on a Guardian article. So it says here, more pain for the Chancellor Reeves as government borrowing costs nears 27-year high. So let's take a look at what's going on here. So the cost of UK government borrowing has jumped to near a 27-year high, piling pressure on Rachel Reeves to reveal how she will tackle the deficit in the public finances before the autumn budget, which is shortly due in the coming weeks. The yield or interest rate on the UK's 30-year bond rose by 8 basis points, that's 0.08 of a percentage point, on Tuesday to 5.62%. That pushed the UK's long-term borrowing costs close to a spike in April of 5.66% when 30-year bonds yields reached the highest since 1998. UK borrowing costs have risen sharply in the recent months gone by, increasing the cost of financing UK government debt to more than £100 billion a year, almost 10% of the annual budget. Now, economists have said the UK faces a unique strain on its financial position at a time when high welfare and healthcare costs and rapid aging are driving up the level of borrowing across most industrialized nations. Reeves is expected to face a deficit of between 20 to 40 billion when she delivers the autumn budget shortly. To maintain her fiscal rules and maintain the £10 billion buffer in place under current plans, the Chancellor will need to find between 30 billion and 50 billion in either taxes, reduced spending, or higher borrowing. Higher borrowing bills and U-turns on proposed welfare cuts have heightened the expectation of increasing taxes later the year. Investors also fear the UK is suffering from high inflation that will persist for several years, devaluing their UK funds. Catherine Mann, a member of the Bank of England's interest rate setting committee, said UK policy makers were underestimating inflation's persistence. She said there is an increasing tension between inflation persistence and weak growth, the trade-off that we currently face in the UK. She said the bank needed to maintain high interest rates to bring down inflation and then cut aggressively to revive the economy. Mohammed El-Erian, the president of Queen's College, Cambridge, an economic advisor to Allianz, said the UK had few domestic and external shock absorbers to relieve both immediate and longer term structural challenges. For example, it lacks the highly dynamic and innovative private sector that the US has, compared to France, has few external safety nets such as the vast resources of the European Central Bank, he told The Guardian. El-Erian added, the core of the UK's problems lie in stagnant productivity. Over the past 15 years, productivity growth has averaged a quarter of the annual average of prior decades. This has created a long-term drag on growth, and its continued absence will put even greater immediate and longer-term structural pressures on the economy. Jagjit Chadha, an economics professor at the University of Cambridge, said the situation was dire, and Reeves needed to get a grip on the government's finances. Chadha, a former head of the National Institute of Economic and Social Research, a think tank, said the government had found itself in a vulnerable situation, and a global economic shock could force the UK to seek a bailout from the International Monetary Fund. The backdrop is a lack of control over public debt, high debt service costs because borrowing rates are high, a dwindling demand to lend to the UK, he said. So, this would be most likely manifesting as a failure in debt management office, auction, and a freezing of the debt market. Okay, it says we are valuable to a global interest rate shock. We are vulnerable to a global interest rate shock or a collapse in confidence in the government, which would leave our fragile position exposed. Our political masters have time and time again shown an unwillingness to raise taxes and lower expenditure, so the markets are increasingly incredulous. My point is that we are now very vulnerable to a bad draw. The Treasury is expected to auction about £300 billion of debt in this financial year, A DMO auction is due to go ahead to raise £5 billion. Charlie Bean, a former Bank of England deputy governor, said fiscal position is not good, though talk of a 50 billion hole and the imminent need for IMF bailout is over the top. But the Chancellor certainly made a rod for her own back when she committed herself both to not raising any of the main tax rates and thus forcing herself to raise revenue in more harmful ways, and also chose to run the public finances with a minuscule buffer of just £10 billion. He said Labour backbenchers had made the situation worse by rendering it all but impossible to cut spending in any meaningful way. Bean said the government needed to raise income tax or better get rid of the age ceiling on employee national insurance and integrate it with income tax so that the burden falls more on the better off oldies like me. Doing so would show that she had seized the initiative and would probably be rewarded positively for doing so by the markets. 3 years ago, Liz Truss's election as the Tory leader and the PM, the yield on a 30-year bond sold by the government was about 2.4%. After the mini budget that Truss orchestrated with the Chancellor Kazi Koteng, the 30-year bond yield jumped to 5% before falling back to about 3.5% after many of the mini budget measures were reversed. By Labour's election victory last July, the 30-year bond yield had risen back to over 4.5% and has climbed since, remaining above 5% since January. There you have it, people. So the UK economy right now in trouble. So you see that the government is borrowing more, and we have a 27-year high here, with the Chancellor's urge to get a grip on country's finances as the 30-year bond rises above 5.62%. So there you have it. The UK economy is struggling, is in trouble. A lot of debt going on there. Do let us know in the comment section below what you think about the UK finances. Obviously, UK inflation is very high as well. So we did do a video early on about UK inflation when it comes to food, with egg prices and butter prices adding to the woes of the country's finances, increasing food inflation. Do let us know in the comment section below what you think about that. Don't forget to like, share, subscribe. Support the channel by clicking the join button, paying a small fee and supporting the channel, the work that we do. Okay, people, catch you in the next one.